It's happening. The United States, along with up to 50 other countries, is establishing coordinated price floors on critical minerals, including silver, copper, rare earth elements, all of the commodities needed for technology, defense, you name it, that up until this point, China has had a chokehold on. Not only because of the supply, but because of their ability to refine these minerals, something that the United States does not have. This could change everything. And make no mistake, it will impact each and every one of us, especially as risk and volatility continue to escalate. Just this week, China came out declaring war on the dollar, wanting to establish the yuan instead as the global reserve currency. So what does all of this tell us about what's coming next? And how does it directly impact you and your financial future? Let's get into it. In case you missed it, on Wednesday, Vice President Vance told a meeting of more than 50 countries that the U.S. will establish a system creating price floors for commodities, going a step further and saying that many countries had already signed on. This is big news. And essentially, we're coming straight for China. Why? Because up until this point, China has been in control of the critical mineral supply. Now, you might be wondering, okay, wait a second. Doesn't the U.S. have these critical minerals too? Aren't we rich and abundant in those? And the short answer is yes. But what many people don't realize is that we don't have the refining capabilities. So they're essentially useless to us. That's what China has, which is why they've been able to hold these critical minerals over the United States and other nations' heads, using it as a geopolitical lever. They could say, we're not exporting these minerals that you need for technology and defense. Your security. It's a top priority now for many nations as we're entering this new era of commodity wars. Right now, the problem here in the United States, again, is that we haven't had the refining capabilities. It's like the US having the nicest car, needing to go somewhere, but there's no gas. Well, you can look at the car, you can enjoy the car, but it's not going to do you any good for what it needs to do. It's not going to get you anywhere, right? That's how it is right now with our critical minerals. Now, many have said, okay, great. Well, why don't we stockpile? Well, just this week, President Trump came out and announced a $12 billion critical mineral stockpile. But eventually that's going to run out. So long term, the US is going to have to invest in ways to refine these minerals. But that could take tons and tons of financing. It could take a decade before we're even at that point. So with price floors now, you don't have to worry about being undercut abroad. This is a big game changer. Not only is it going to create even more demand for these commodities, it's going to be a boom, essentially, for critical minerals and commodities in general. It's going to establish the United States on a track to potentially be a rival to China in the future when it comes to refining critical minerals. But more than that, it's also going to create more geopolitical risk. Not that we don't have enough of it, but the commodity wars between the US and China are heating up in a variety of ways, not just with critical minerals, but with monetary metals as well. Of course, I'm talking about gold. Just this past week, there was a commentary published in Geopolitical, which is China's ideological journal of the Communist Party, in which President Xi Jinping outlined his plans to have the yuan replace the dollar as the global reserve currency, and do so using gold. Now, we've known for a long time that gold was at the center of China's plans to overthrow the dollar, or essentially position themselves at the center of the new monetary system. But stockpiling gold alone is not enough. I've been saying this for the better part of a year. You can have all the gold in the world if you're China, which is something they want to have. We'll get to that in a second. You can have as much gold as possible. But if the pricing and the settlement and the clearing and all of the payment rails internationally are still dictated by the West through the dollar, well, then you're not going to have very much success. Which is why China wants to make sure they are the world's #1 holder, producer, importer, and consumer of gold. They want to own and control the gold. Now, how are they doing that? I've talked about this before. They are quite literally building the infrastructure to support gold as the anchor of this new system. Why? Because foreign nations don't want the yuan as the new global reserve currency. They're done with the fiat experiment. Been there, done that, and it burned them all. In the 1940s, the Bretton Woods Agreement was created. The United States dollar was positioned at the center of the system, backed by gold. And of course, in 1971, President Nixon delinked the dollar from gold, effectively defaulting, an outright default on the United States' promise to the rest of the world. And so what happened? Everyone's stuck in this dollar system, and they're done. Well, Xi Jinping can smell blood in the water. Because once the United States froze and seized Russia's reserves back when they invaded Ukraine, ever since then China, along with the BRICS nations and a handful of other nations, have all been focused on de-dollarization. Or how do we undermine the dollar's dominance? How do we reduce our reliance on dollar reserves, dollar trade, and create a new parallel monetary system? One that cuts the dollar out. And again, this is incredibly important to every single person out there watching, because the dollar is the global reserve currency. So as it continues to be utilized less and less, which is happening for anyone out there who says, "Oh, that'll never happen," listen to this. As of Q3 of 2025, the dollar accounted for about 57% of global reserves, down from 71% in 2000. That's what's happening to the percentage of global dollar reserves. As those reserves continue to go down, as there is less demand for US debt, what happens? Well, the United States isn't going to stop spending anytime soon, but you need more buyers. But we have fewer buyers. So then what? Well, you have to up those yields. You have to increase the interest you're offering, which makes it infinitely harder for the US to service its debt. This is a debt doom loop. It gets more expensive, meaning we have to print more, spend more. Fewer people want it. This is going to lead to massive inflation, rapid inflation leading to hyperinflation. We've seen this play out time and time again. It's a cycle. It's a pattern. We can study it throughout history. And China's not giving up. And again, they're smart because they're doing it through commodities. Trust in fiat, trust in paper has completely crumbled. So instead, they're building a new system based around gold. They have the critical minerals over here that only they can refine. Now the US, again, this is a big deal, is coming out and saying, hey, we're going to counteract this. We're going to create price floors, and we are going to establish ourselves as this counterweight to China. But it's going to take some time. If anything, what this tells us, again, is that commodities are going to be more and more important. Physical, tangible gold, silver, things you can hold, things you can trust. The paper promises of yesterday, the made-up numbers on a screen, they are not going to be as important in the future, because everything that you have that's dollar-denominated, everything you have in fiat currency, will be devalued. We've seen this play before. The bottom line is this is a massive strategic shift. This is a big deal, and we're going to see how it all plays out. But for everyone out there who's holding silver and gold, or who has not yet protected themselves with silver and gold, silver as a critical mineral, absolutely. If there's a price floor established, you can expect to see silver prices continue to rise. Gold, we're going to see more risk, more volatility. We're seeing China taking aim at the dollar. We're seeing the United States coming right back at China and saying, not so fast. As this war continues to escalate, of course, we're going to see gold prices go up too. And as China continues to say, we want to be the largest holder, producer, consumer of gold. What do you think's going to happen to gold prices? So my advice to everyone out there watching is if you do not already have your physical gold and silver, it's going to be more difficult to get in the future. Yes, you can get it, but it's going to be more expensive than it was today. Now, the biggest piece of this, though, is to not just rush out and buy gold and silver because you're panicked. We want to make smart decisions. So if you don't already have a strategy in place, one that has physical gold and silver at the center of it, or if you do but you want a second opinion, call us at the number below or scan the QR link to talk to one of our expert analysts. This is what we study day in and day out. We are a full-service physical gold and silver dealer, but we also specialize in education, in helping people just like you create a custom strategy for what's coming next. Because again, things are heating up here. They're not slowing down. Things are only happening at a more accelerated pace. And whatever you think you have in place today, all I can say is I don't think we have enough gold for what's coming next. Now, if this was helpful for you and you want to share it with a loved one, please do. It helps us spread the word on Newsix Brief. And as always, thank you so much for being here. Let me expand on what this really means for the global economic order and why understanding the commodity dimension of great power competition is essential for protecting your wealth in the years ahead. Because what we're witnessing isn't just a policy shift or a trade dispute. It's a fundamental restructuring of how economic power is projected and maintained in the 21st century. For the past several decades, economic dominance was primarily about financial control. The country that controlled the reserve currency, the banking system, the payment rails, that country had leverage over everyone else. The United States built an empire not through territorial conquest, but through dollar hegemony. Every country needed dollars to trade, to buy oil, to settle debts. This created automatic demand for U.S. Treasury bonds, which allowed America to borrow at artificially low rates and run deficits that would bankrupt any other nation. But we're entering a new phase where physical resources matter more than financial engineering. You can't run a modern economy, you can't build defense systems, you can't manufacture advanced technology without access to critical minerals. And here's the crucial point. These minerals aren't evenly distributed around the world, and more importantly, the infrastructure to refine them isn't either. China understood this decades ago. While America was focused on financialization, moving manufacturing overseas, building service economies, optimizing shareholder returns, China was quietly building the physical infrastructure of the future economy. They invested heavily in mining operations around the world, particularly in Africa and South America. They built the refining capacity that turns raw or into usable materials. They created entire supply chains that funnel these critical inputs into Chinese manufacturing. The result is that today, China controls somewhere between 60% and 90% of global refining capacity for various critical minerals, depending on which specific mineral you're talking about. For rare earth elements, it's even higher, over 90% in some categories. This gives China enormous leverage. They can restrict exports, they can manipulate prices, they can essentially hold hostage any country that depends on these materials for their economy or defense. This is why the U.S. announcement about coordinating price floors with 50-plus countries is so significant. It's an admission that the old financial-based model of power projection isn't sufficient anymore. You need physical resource security. You need supply chain resilience. You need the ability to refine and process critical materials domestically or through trusted allied networks. But here's the uncomfortable truth. Building this capacity takes time and enormous amounts of capital. We're talking about a decade or more to develop competitive refining infrastructure. We're talking about hundreds of billions, potentially trillions, of dollars in investment. And even then, there's no guarantee of success because China has spent 30 years building expertise, supply relationships, and economies of scale that can't be replicated overnight. This is where the price floor mechanism becomes crucial. Without price floors, China could simply dump refined minerals onto the global market at artificially low prices, undercutting any Western attempt to build competing infrastructure. It's the same strategy they've used in solar panels, steel, and numerous other industries. Subsidize domestic production, flood global markets, destroy competitors, then raise prices once you've achieved dominance. Price floors prevent this race to the bottom. They create a guaranteed minimum price that makes it economically viable to invest in Western refining capacity. They send a signal to capital markets that these investments won't be wiped out by Chinese predatory pricing. It's economic warfare, and both sides understand the stakes. Now let's talk about the monetary dimension, because this is where things get really interesting. China's push to establish the yuan as a reserve currency isn't new. They've been working toward this for over a decade. What's changed is the mechanism they're using, gold. Here's why this matters. When Nixon broke the link between the dollar and gold in 1971, it was supposed to be temporary. It became permanent because the U.S. was able to maintain dollar dominance through other means: the petrodollar system, network effects, military power, the SWIFT payment system. But trust in fiat currencies has been eroding, particularly after the 2008 financial crisis and the massive money printing during COVID. Countries watched as the U.S. essentially created trillions of dollars out of thin air, devaluing the savings of every country holding dollar reserves. Then they watched as the U.S. and Europe froze Russian foreign exchange reserves after the Ukraine invasion. An unprecedented move that sent shockwaves through every central bank in the world. If they could do it to Russia, they could do it to anyone. This created a crisis of confidence in the dollar-based system. But replacing it isn't simple because nobody wants to trade one unreliable fiat currency, the dollar, for another, the yuan. The solution China is pursuing is to anchor the yuan to gold, creating a quasi-gold standard that gives foreign countries confidence that their yuan holdings won't be arbitrarily devalued. This is why China has been accumulating gold at unprecedented rates. They're not just stockpiling it for no reason. They're building the foundation for a new monetary system. They're creating gold-backed bond markets, gold trading infrastructure in Shanghai, gold settlement mechanisms that bypass Western systems. They're literally building a parallel financial architecture based on hard assets rather than fiat promises. The implications of this are staggering. If China succeeds in creating a credible gold-backed alternative to the dollar, it would fundamentally alter global power dynamics. Countries would have a choice for the first time in 50 years. Trade in dollars and accept U.S. financial surveillance, sanctions risk and devaluation, or trade in yuan backed by gold with China as the central node. For the average person, this means several things. First, the dollar's purchasing power will continue to erode as its reserve status declines. You're already seeing this in the numbers, from 71% of global reserves in 2000 to 57% in 2025. That trend isn't stopping. Every percentage point decline means less global demand for dollars, which means the U.S. has to pay higher interest rates to attract buyers for its debt, which means more expensive government borrowing, which means more money printing, which means more inflation. It's a vicious cycle, and there's no easy way out. The U.S. can't suddenly stop deficit spending without causing a massive recession. It can't raise interest rates too high without making its debt burden unsustainable. It can't stop printing money without causing deflation and economic collapse. So the money printing will continue, the dollar's value will continue to decline, and anyone holding wealth primarily in dollar-denominated assets will see their purchasing power erode. This is why physical assets, particularly gold and silver, become so important. They're not denominated in any country's currency. They can't be printed. They've held value for thousands of years across every civilization and political system. When fiat currencies compete in a race to the bottom, when central banks are printing money to finance unsustainable debts, when geopolitical tensions threaten financial stability, that's when hard assets preserve wealth. Silver is particularly interesting because it sits at the intersection of monetary value and industrial necessity. It's used in electronics, solar panels, batteries, medical equipment, all the technologies that are growing rapidly. But it's also historically been money, a store of value, a hedge against currency debasement. This dual nature means silver benefits from both industrial demand growth and monetary demand as a safe haven. The establishment of price floors for critical minerals, including silver, adds another dimension. It creates a guaranteed minimum value, which reduces downside risk for investors and increases the attractiveness of building reserves. Combined with growing industrial demand and monetary demand from de-dollarization, you have a perfect storm of factors pushing silver prices higher. But, and this is crucial, timing and strategy matter. Panic buying at the top of a short-term spike is how you lose money. Understanding the long-term trends, accumulating strategically during pullbacks, diversifying across different forms, physical, mining stocks, ETFs, and maintaining discipline. That's how you build wealth in commodity cycles. The geopolitical commodity war we're entering will define the next several decades. The countries that secure access to critical minerals and build refining capacity will have enormous advantages. The countries that accumulate gold and build alternative monetary systems will challenge dollar dominance. And the individuals who position themselves in hard assets ahead of these shifts will preserve and grow their wealth while fiat currencies devalue. This isn't speculation. This is the logical consequence of policies already in motion. The question isn't whether these trends will continue, but how quickly they accelerate and how severe the dislocations will be. Being prepared, being educated, and being positioned properly isn't just smart. It's essential for navigating what's coming next. Thank you for watching Nuzik's Brief. Until next time.